If you're trying to manage your own money, you have to stop obsessing about numbers like today's Consumer Price Index reading. First of all, the CPI is made up of so many hard-to-parse components that you might end up selling stocks based on the elevated price of sports tickets or the cost of a tie at TJ Maxx. Second, it doesn't matter anymore. We had to be concerned about this stuff when the Fed was on the warpath, either raising rates or leaving them higher for longer. Now, though, the Fed is your friend, so I wouldn't obsess about the details, aside from the monthly labor report, which is still genuinely important. These days, it feels like we've all become Fed watchers, which means we've all become hacks. A hack is someone who'd rather rely on some spoon-fed government data than do any homework about what's happening at actual companies. Even Austin Goolsbee, the president of the Chicago Fed, told us not to fixate on this number this morning because the Fed won't key off of it. It drives me nuts how so many people get so obsessed with every macro number that comes across the screen. You have to care about this stuff when the Fed's raising rates in order to stay about inflation. It can be very important when we're in a rate hike cycle. You're trying to figure out when that's going to end. But we're not in that kind of cycle anymore. We're in a rate cutting cycle. The Fed gave us a double rate cut last month, and whether or not we get another cut at the next meeting, we know the general direction is down. Sure, if we had a huge spike in the CPI this morning, then maybe the Fed would change its stance, but that would have to be an extreme reading. And there's nothing extreme about today's 2.4% inflation number, just a tick above the expected 2.3, still down from the 2.5% reading from the prior month. If the CPI is not extreme, you know what? You can actually just ignore it, especially right now, because earnings season kicks off tomorrow. Never forget, we're in the business of investing in individual stocks, not betting on the CPI like some sort of like DraftKings over that you got to take or the under. I think we in the media often steer individual investors in the wrong direction. We treat every data point like it's sacrosanct, and somehow they're all created equal. We can be part of the distraction that clouds your judgment and directs your attention to things that have nothing to do with picking stocks, our bad. For example, we need to get our heads in the game if we're going to figure out whether it's worth pulling the trigger on financial tomorrow when the big banks start reporting. But if we can't do that, if we're pouring over the CPI, going over the cost of insurance or used cars or the price of eggs, we're not doing our job right. At this point in the business cycle, none of that stuff is relevant to the broader economy or to individual stocks or, frankly, even to your portfolio. When you see the producer price index tomorrow morning at the same time as you see these earnings from Wells Fargo, Bank of New York, Mellon, BlackRock, and JP Morgan, you need to recognize they are not equivalent. They don't cancel each other out. The earnings matter, and the PPI is just not that important until maybe when the Fed's finally cutting rates, something that's not going to happen anytime soon. This morning on Squawk on the Street, I lamented to my partner, Carl Quintanilla, that I never bought any BlackRock stock for my Travel Trust. I found myself musing that perhaps I got distracted by the Fed commentary, the macro numbers that I thought were important, the hotter-than-expected CPI or PPI, or whatever else has probably cost my Travel Trust more than any individual errant stock pick. I missed opportunities because I was focusing on the ephemeral and not on the substantive. Of course, it's hard to convince you not to focus on these numbers when the business media covers them extensively, me included. There are some hedge funds managers, they do follow this stuff closely, minutely even, every time, because they may be whipping around the bond market, which does make small moves on many macro numbers. But you should only play that game if you're an institutional investor with a lot of leverage. You sure don't need me for that. I'm confident that I would have made a lot more money for the trust if I just focused on the individual companies and not the macro data, with the sole exception of the labor report, which, again, does influence Fed policy. So forget the macro, people. It's not that meaningful when the Fed's cutting rates. And keep your eyes on the prize, earnings. At the end of the day, the earnings are what control stock prices long-term. And stocks are what we're trying to make money on. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.